When you want to buy a sneaker, you go to a shop, you look at the range of options available, you try out some of them, and then you make your choice. But while buying a financial product, it usually does not work out like this. First, only a few people can actually map out what they need from the product. And second, even if the product has the needed characteristics, it's difficult to evaluate them properly. And the bad part is कि कई बार तो realization ही नहीं होता है, and होता भी है तो कई साल बाद that you have made a mistake. There are many people whose investments and insurance have done badly, but they're only vaguely aware that it could have been better. So even if you are very good at budgeting and savings, but if you invest in the wrong financial product due to lack of knowledge or in the hopes of getting exceptional returns, there is a chance that your money may disappear. So what are these financial products that you should stay away from? Let's see. Number 1, unit-linked insurance plan. A ULIP is a combination of investment and insurance. The premium that you pay for ULIP is divided into two parts. One part is used to give you life cover, and the second part is invested on your behalf. The investment could be in equity funds or debt funds or a combination of both. The return of this will depend on the fund's performance, market conditions, and others. So basically saying that the return is subject to market risk.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Now, you may think that ULIP is the best investment option. 2-in-1 benefits. You are getting insurance cover as well as doing some investment. But the problem with ULIP is you are neither getting good return nor you are getting a decent life cover for the premium that you are paying. Firstly, the premium paid on ULIP is much higher than what you would pay on a pure insurance product. So for example, if you pay 1 lakh rupees as premium, in case of death, the nominee would get a payment of 10 to 12 lakh rupees. And if the investor survives, he or she will get the amount of premium paid plus the return on their investment. And you see, the coverage that ULIP provides is low. Instead, it would be better to buy a term plan. So if you are in your 20s and you buy a term plan for 40 years for around 1 crore of coverage, you would get this in about 8 to 10,000 rupees per year only. Secondly, there are multiple charges involved in ULIP. For example, mortality charge, administrative charge, premium allocation charge, and more. So what happens is a sizable chunk of your investment during the initial years goes towards this, which basically reduces the amount that is invested, which ultimately leads to lower return for you. The third drawback of investing in ULIPs is the lock-in period. Usually ULIPs have a 5-year lock-in, but nowadays some of the product also have a 3-year lock-in period. But when you compare this with mutual funds, there is no lock-in period for mutual funds. However, if you redeem the mutual funds before 1 year, you may be charged an exit load for some of these. Let me tell you the fun part that happens when you surrender the policy during the lock-in period. Your insurance, the risk cover, basically ends when you surrender the policy. Logical, right? But you will not get any money back right now. Your amount will be transferred to the discontinuance fund and you will be charged a discontinuance fees. And even though you have surrendered this policy, fund management fees will still be charged. And during this period, you will only get around 4% return. The total amount will be transferred to you only after the end of the 5-year lock-in period. Now, you may think, why do people invest in ULIP if it's such a bad product? Well, the major reason is that banks promote this product a lot because they get a lot of commission on it. And people don't know the drawbacks. The second major reason is the tax benefits. The investment in ULIP is allowed as a deduction under section 80C up to 1,50,000 rupees. So लोगों को लगता है कि insurance भी हो गया, investment भी हो गया, tax भी बच गया, और क्या चाहिए? So what I'm saying is, separating insurance and investment is a good idea. If you have 1 lakh rupees to invest in ULIP, spend 15,000 on the term insurance plan and invest the remaining 85,000 in a mutual fund. The term plan will give you a better coverage for your life and the mutual fund will give you a better return. Do you find this information useful? Do hit the like button. The second product is regular mutual funds. Now, I'm not asking you to stay away from mutual funds. I'm asking you to be smart about maximizing your return. So there are two ways in which you can invest in the mutual funds: direct and regular. A direct plan is what you buy directly from the mutual fund company or through platforms like Grow and others. But in regular plan, you buy through a third party like a broker, a dealer, or a distributor. In regular plan, the investment company has to pay some commission to this third party. And this adds to the cost of the mutual fund, which basically increases the expense ratio and reduces your return. The same mutual fund manager manages both the direct and the regular fund, and even the money is invested in the same asset, but the returns are different. Today, when everything is digital and online and can be done with a click of a button, it makes sense to invest in the mutual funds on your own. If you are someone who has a fair knowledge of market and the mutual fund, you should ideally opt for direct mutual funds. The third financial product to stay away from is gold jewelry. As Indians, we have all grown up listening to our parents saying कि gold खरीदना चाहिए, problem के time पे काम आता है. We put money in gold without giving it a second thought. Well, gold as an asset class is really important, but buying it in the form of jewelry is not a good investment. When you are buying jewelry, you will be paying for making charges, which will increase the cost of gold per gram. Again, when you will be selling this jewelry, you will be paying for melting charges, which will reduce your return. And you would have noticed that the gold jewelry is usually in the form of 18 or 22 karat gold, which is not the pure gold. Another way to invest in gold is to buy digital gold. As the name suggests, digital gold is bought online and the seller keeps it on your behalf in a vault. The seller will also charge you some fees, which is called spread cost, which will include the storage cost, insurance, and others. This is usually between 3 to 6%. Now, a lot of the platforms that provide this service have a limit of 2 lakh rupees that can be invested. But again, this is not regulated by any regulatory body like SEBI. So again, there is some risk involved here. The best way to invest in gold is through sovereign gold bonds, the SGB, issued by the Government of India. Now, there are 4 primary advantages of SGB. First, they are issued at the prevailing market rate of gold, or sometimes even at a little bit discount if you make the payment online. Second, you earn an additional 2.5% interest on your invested amount. Number 3, it is issued by the government, so it is safe and risk-free. And number 4, the capital gains are not taxable if you hold this till maturity. So the tenure is around 8 years with an option to exit after 5th year. The fourth product to avoid is high return bonds and debentures from unreliable entities. Now, when bank FD offers 6 to 7% return and bonds offer 10 to 12%, तो देख के अच्छा तो लगता है. But you need to realize that you are being offered higher return for the extra risk that you are taking by giving these companies your hard-earned money. And a lot of these high interest yielding products come from not so reliable companies which may fail to repay you in tough times. The highest investment rating is AAA. If you're looking for safe avenues to invest in AAA rated bonds. If you're okay with some risk, you may go for AA rated bonds as well. Number 5, credit card loans. The interest rate on the credit card loan is around 40% per year. You are smart. Do I need to say anything else? We have a very interesting video on how credit card works and how these companies would want you to default on your payment so that they can make some money. If you have not watched it, I would highly recommend you to watch this interesting video. One last bonus product. Number 6, avoid any financial product that is not regulated. There are many unregulated financial products available in the market, like chit funds, forex trading, binary options, contracts for difference, and others. Now, these investments claim to offer very high returns, but they are also extremely risky. Because these products are not regulated by any regulatory body, they lack transparency and they involve several malpractices. The liquidity is also very low. So, how do you make sure that you do not buy the wrong financial product? The simplest way is to answer these 5 questions. Number 1, do I truly understand how this investment product works? Will I be able to explain this to a friend or to another person who has zero knowledge about this product, and will they be able to understand it? Number 2, do I understand what are the fees and commission for both initial and ongoing payments? Number 3, what are the risks involved? Number 4, how liquid is the investment? If I want to exit at one point and want my money back, will I be able to claim it? And does my current financial situation allows for such illiquidity in my portfolio? And finally, number 5, am I just making the investment because everybody else is doing so? While you must try and maximize the returns, it is also important that you do not get stuck with random loss-making products. Invest in investment products that make sense to you and stay away from the dangerous traps. Hit the like button if you find this video useful. Click subscribe and press the bell icon. Wrapping it up, this Paritosh signing off.